Welcome to Factful Finance. Did you know that the average American investment portfolio returns less than 7% annually? That's a number that might surprise you, but understanding how to calculate your return on investment, ROI, can make a huge difference in your financial success. Let's dive into the essentials of calculating ROI so you can start measuring your investments effectively and get the most out of your money. First, a quick disclaimer. This video is for educational purposes only. For personalized advice, be sure to consult a professional. ROI is a key metric in the world of finance, and knowing how to calculate it gives you an essential tool to evaluate your investments, whether you're putting money into stocks, real estate, or even a side business. But what exactly is ROI? Simply put, ROI measures the profitability of an investment relative to its cost. The formula for calculating ROI is Cost ROI equals current value of investment, cost of investment x 100. Let's break that down. Say you invested $1,000 into a stock, and a year later, that investment is worth $1,200. To calculate the ROI, you subtract the original cost $1,000 from the current value, $200, which gives you $200. Then divide that $200 by your original investment of $1,000 and multiply by 100 to get a percentage. ROI equals 1,200 minus 1,000, 1,000 x 100 equals 20%. That means your investment has returned 20% over the year. Now that's a solid return. But what if the return is negative? Let's say you bought into an investment for $1,000 and after a year it's worth $900. Your ROI would look like this. ROI equals 900 minus 1,000, saying 1,100 equals maybe 10%. In this case, you've lost 10% on your investment. While the basic formula is simple, there are some nuances to consider when calculating ROI, especially when multiple factors come into play, like dividends, taxes, or additional investments. For example, when calculating the ROI on a real estate property, you should include factors like property taxes, maintenance costs, and potential rental income to get a clearer picture of profitability. Let's take a real-world example. Meet Mark. Mark invested $50,000 in a rental property. Over the course of a year, the rent he collected was $6,000. But after accounting for expenses like property taxes, insurance, and repairs, totaling $2,000, his net income from the property was $4,000. To calculate his ROI on the rental property, Mark uses the formula Cost ROI equals net profit cost of investment x 100. ROI equals 4,000 to 50,000 x 100 equals 8 cents. So Mark earned an 8% return on his real estate investment. This is a helpful calculation because it shows how well the investment is performing, not just in terms of income, but also in relation to its initial cost. Now, if you're wondering what an ideal ROI is, there's no one-size-fits-all answer. The ROI that's acceptable to you depends on your investment goals, risk tolerance, and time horizon. For instance, long-term investments like stocks or mutual funds might offer lower annual returns but have the potential for higher growth over time. On the other hand, riskier investments like startups or cryptocurrencies can yield higher returns, but they also carry greater risk. When comparing different investments, ROI gives you a clear picture of which option is generating the best returns. But remember, it's only one metric. You should also consider factors like volatility, liquidity, and the level of risk involved. Let's wrap up with a quick tip. Keep track of your ROI regularly and use it to evaluate whether an investment is meeting your financial goals. Tools like investment calculators or portfolio tracking apps can help you monitor your returns with ease. Now, let's hear from you. Have you ever calculated your ROI on an investment? What's the most important factor you consider when evaluating a potential investment? Share your thoughts in the comments below. Thank you so much for tuning in to Factful Finance. If you found this video helpful, be sure to like, subscribe, and click the bell so you won't miss any future financial tips. Remember, when you take control of your ROI, you're taking control of your financial future.